Hi traders, you're welcome back to the Forex Geek channel, and in this video we're just going to be covering the Forex trading mistakes that you should avoid in order to get consistent profits. Okay, these mistakes are some of the biggest reasons traders struggle to grow their accounts. So by the end of this video, you'll know exactly what to avoid and how to trade with more discipline. First of all, I believe you will know this already, but well, I still have to mention them. And congratulations if you guessed the first one right. The first mistake is over leveraging. Now, over leveraging might be a common word that you hear all the time, but many traders see leverage as an opportunity to multiply gains, but it can just as easily multiply losses. Now, let us say you have $100 account, and quite all right, you found a good move in the market. We are not saying that you did not find a good move in the market. You actually found a good move in the market. Let's say you spotted a resistance zone, you spotted uh a key resistance, and then you even spotted a break from a bullish trend line and whatnot, and perhaps price came back, retested your breakout zone, you got your confirmation, and then you finally wanted to enter your trade. And then with your $100 account, instead of entering with a smaller lot size, you decided to use lot size zero point 0.1. You decided to use a mini lot size. Now the trade might eventually go in your direction, but remember that price does not move in a straight line. Okay, so when you are using a higher lot size than you ought to use, it is possible that the fluctuations in the market could end up blowing your account, and at the end of the day the price will still move in your direction. So avoid over leveraging, avoid it at all costs. Okay, make sure that you do not make that mistake. The key is to keep leverage low and position sizes aligned with your risk tolerance. Protecting your capital is more important than chasing large wins. Okay, the second mistake is trading without a plan. If you enter the market without clear entry and exit rules, you are relying on emotion instead of strategy. A solid trading plan outlines when to enter, when to exit, how much to risk, what conditions must be met before placing a trade. Just like this example that I gave right here, your strategy could be based on support and resistance levels and breakout. So, for example, you wait for price to bounce off a resistance or to bounce off a support, depending on if it's a bullish or a bearish trade. And then you use a trend line to get confirmation. For example, price was bouncing off a resistance, and then you use the bullish trend line and you wait for a breakout and a retest. That could be your strategy. You don't have to use this particular strategy. There are different strategies, many strategies out there, but make sure that you have defined entries and exit criteria, and you also have defined risk parameters. You know exactly how much lot size you are using, you know exactly how many percentage of your account you are risking per trade, and all of that. It's very important. Okay, you must trade with a plan. Without a plan, you'll end up making impulsive decisions, which often leads to losses. Now, the third mistake is ignoring risk management. This is one of the fastest ways to fail in forex trading. Even the best strategists will have losing trades. That you need to understand this fact. Okay, so managing your risk is essential. Always set a stop loss. Never risk more than 1 to 2% of your account on a single trade, and aim for a good risk to reward ratio. For example, now you can see this particular example. If you look at this, you will see that the risk to reward ratio is 1:2, right? And if you check closely, you will see that that is actually a valid risk to reward ratio, because this particular level, right, was used as our exit. Okay, this level, this is a zone where price was rejected 2 times. It's just a zone, right? and that's the level that was used for our take profit. And then we entered after we had a breakout and a retest. So you can see the structure, and then our stop loss was above the recent high. And then because we had a good risk to reward ratio, we had to enter the trade. So make sure that your risk to reward ratios are always minimum of 1:2. Okay, it's important that you observe good risk management. Set your stop losses properly, never risk more than 1 to 2% of your account on a single trade, and aim for good risk to reward ratios so that your winners will always outweigh your losers. Now, the fourth mistake is overtrading. This happens when traders take too many trades in a short period, especially out of boredom or the need to make back losses. Now, I understand those who are scalpers, okay? I'm not saying that you should not be a scalper. Feel free to be a scalper and to take many trades. But now, the direction that I'm coming from is emphasis on overtrading because of boredom, or rather out of boredom or the need to make back loss. If you are a scalper, it's a normal thing to take multiple trades, right? But when you start trading because of boredom, then there is a problem, okay? Because you are now trading out of emotions. Of course, it's boredom is an emotion, right? When you're feeling bored, it's an emotional state. So when you are trading out of boredom, there is a chance that you might make unnecessary wrong trades, okay, unnecessary mistakes. So do not trade out of boredom, and do not trade because you are trying to make back losses. Stick to your strategy. It's very important. The problem is that overtrading increases your exposure to risk and usually lowers your trade quality. So focus on patience. Wait for setups that truly meet your criteria instead of forcing trades. Now, the final mistake, the fifth mistake, is chasing the market. This is when you see a big move and you just jump in too late out of fear of missing out. For example, now, if you are using the break and retest strategy, in as much as some traders might actually jump into the trade immediately after the breakout happens, but some traders prefer to wait for a retest to confirm that that breakout is valid, a retest and then a confirmation candlestick pattern. So now it depends on your own style, okay? But most importantly, make sure that you do not just jump into a trade, especially when it is already too late. Okay, more often than not, you enter just before the market reverses. Instead, train yourself to wait for pullbacks or confirmation signals before taking action. Okay, discipline is what keeps you consistent. Now, to trade consistently, you must approach the market like a professional. That means having a plan, following your rules, keeping risk under control, and avoiding the temptation to overtrade or chase moves. The market will always present opportunities, so you do not have to take every single one. By avoiding these Forex mistakes, you give yourself a much better chance for long-term success, okay? If this breakdown was helpful, click the like button and subscribe so you can keep learning strategies and tips to improve your trading performance. Thank you for watching, and I look forward to seeing you in the next video. Happy trading.